Hi everyone, this is me Dr. Santosh. Once again, I would like to welcome you all for a new video of Yes Edu Talks. So in this video, what I am going to tell you is about accounting for amalgamation, what is purchase consideration and what are the methods of purchase consideration. You know that Vodafone and Idea, Vodafone India Limited and Idea Cellular Limited were the very big players in Indian telecommunications sector. But what happened that because of the continuous loss reporting in their financial statements, in 2018, they stopped their business and joined together and formed as a new company which is known as V. So right now, Vodafone and Idea is doing their business in the name of V. So all the two companies were liquidated and a new company is formed. This is what is known as amalgamation. So what amalgamation by meaning is that when two or more companies carrying on the similar business go into liquidation and a new company is formed to take over the business of existing company. That means they should have at least two companies and also they should have to do the same type of business. What happened? They went into liquidation and after that a new company came into existence to take over the business of all those old companies. So this is what is known as amalgamation. In our example, Vodafone and Idea both stopped their business and a new company called V, they acquired the business of both Vodafone and Idea. So this is what is known as amalgamation. However, absorption is also a term which may be related to the concept of amalgamation. Absorption means when an existing company takes over the business of two or more existing companies. But in case of amalgamation, there should be the formation of a new company, that is compulsory. But in case of absorption, an already existing company takes over the business of an old company, it is known as absorption. So there is a slight difference between amalgamation and absorption that you should have to be kept in your mind while thinking about amalgamation. There may be a new term, reconstruction, which can be related to the concept amalgamation and absorption. Actually, reconstruction means the reconstruction of a company's financial structure. What do you mean by financial structure? The combination of their capital, that is known as financial structure. If it is restructured, we can call it as reconstruction. That means amalgamation also can be a reconstruction. Okay, so reconstruction can be classified as two: external reconstruction and internal reconstruction. What is external reconstruction? If the company is going into reconstruction is liquidated, that is a company which is liquidated and as a part of that it is got restructured, then it is known as external reconstruction. So physically there will be a complete reconstruction. But in case of internal reconstruction, if the company is going into reconstruction is not liquidated, that is physically there will not have a reconstruction. So outsiders cannot know if the internal reconstruction happened. For example, a company's capital was like this: equity share capital 1 lakh and preference share capital 2 lakh. And what company decided? They want to change this, that is they are actually changing preference from 2 to 1 but increasing equity from 1 to 2. This is what is known as internal reconstruction. There will not have any outside effect. However, the financial structure got changed. So this is what is known as internal reconstruction. But amalgamation is not like that. It is actually a part of external reconstruction. Okay, so hope you get an idea of what is reconstruction. What is acquirer and acquirer? A company which is going to be liquidated, or otherwise a business that the acquirer obtains control is known as acquiring company. In our previous example, Vodafone and Idea both were acquiring company. But in case of acquirer means what? V, because the company who takes the control of acquiring company is known as acquirer company. Let's see what are the features of amalgamation. I told you that there must have at least two companies. That means two existing companies should be there and a new company to take over the business of two or more existing companies. So two or more existing companies must be there. Then it will be amalgamation. And all the existing companies should be liquidated. They should have to stop their business and a new company take over the business of old companies. That means they should have to be liquidated. So two features are very simple. And also a new company should be there to take over the business of all existing companies. So only 3 points we should have to be kept in your mind. That is, they should have at least two companies and they should be liquidated and a new company must be formed to take over the business of old companies. And what will be the value of these two companies? For example, Vodafone and Idea, individually they have some values. Maybe they have a worth of rupees 1 lakh and 1 lakh each. That is 1 lakh each. Fine, that will be better. And if these two companies were liquidated and V takes over the business of these two companies, definitely we have a worth of 2 lakh. isn't it? So that means the value of new company formed is expected to be greater than the total of independent value of old two company. That is so simple, because they are taking two companies. Each company have their own value, and both companies taking over by the new company, then definitely that new company will have a value which will be the combination of the independent value of all two companies, right? And what's the purpose of this? Why the companies are going to be amalgamated? It is simple, to get economies of scale, because if they join together, they can save a lot. Productivity will be increased. That is known as economies of scale. So the first purpose of amalgamation is what? Economies of scale. And second, savings can be caused through the elimination of duplicate activities, because they both are doing the same business. If they join together, a lot of similar activity can be done together. That means they can bring lot of savings through the way of elimination of duplicate activities. And the last, avoiding cutthroat competition. So these are the aims or even objects which every company goes for amalgamation. Another important aim which is related to amalgamation that you should have to be give much more importance is about the purchase consideration. Fine. I want to tell you two more things. There will be two companies, acquiree and acquirer. That is the company which is going to be liquidated and a new company. Fine. So the acquirer company takes over the business of acquiree company. Fine. That is, acquiree company is going to lose everything, because acquirer is going to take over. So that means acquiree company is going to lose everything. Fine. So they need to get something as return, right? Who will give? Acquirer company will give. That means acquirer company will give some amount to the acquiree company for taking over the business of them. That is known as purchase consideration. Simply, it is the amount paid by the acquirer company to taking over the business of whom? Acquiree company. And there are four methods through which you have to calculate purchase consideration. They are lump sum method, net worth method, net payment method, and intrinsic value method. So these are the four common methods which every company is using to find out the value of purchase consideration. Also, you have to calculate. What is lump sum method? In lump sum method is very simple. The acquirer company will decide an amount. Maybe acquirer and acquiree company together will decide an amount, and that will be a large amount, a sum of money that will be given by the acquirer company to the acquirer company to the acquiree company. That means when the acquirer company agrees to pay a fixed sum of money to the acquirer company, there is no confusion, there is no calculation, there is no difficulty. They together fix a sum of amount that will be the purchase consideration. That means acquirer company will say that I am going to give this much of amount to you, and I am going to take out the business of you. So nothing more. So this is what is known as lump sum method. Nothing to be calculated. But second method is something different. It is known as net worth method or net asset method. Then you have to know what is net worth. Net worth simply means the total value of asset. For example, imagine there is a balance sheet. In a balance sheet, asset and liabilities will be equal. So the acquirer company is going to take over all the assets of acquiree company, because that is the worth they are going to get. Fine. So they will take the total of these assets. Fine. And from that value, they will deduct all external liability, because they also want to pay the liabilities of this acquiree company. So net worth means finding out the total of assets, and from that value they will deduct the liabilities. So the difference between the total value of assets minus of external liability is known as what? Net worth. Then they will get the money that is the value of that business which they purchased. So this is known as net worth method. So purchase consideration is calculated by taking the net worth of the assets taken over by the acquirer company. Fine. How to calculate net worth? Agreed value of assets minus agreed value of external liability. Listen, assets minus liability. What is mean as agreed value? What do you mean by agreed value? Agreed value means the value of assets they agree to take. Whom? Acquirer company. And also the value which they agree to pay. That is known as agreed value of liability. Simply assets minus external liability. Fine. There are some more points you should have to be kept in your mind while calculating net worth method for finding out the purchase consideration. First, assets will always include cash in hand and cash back. As in your question, it will say that the acquirer company will take over all the assets of acquiree company. All assets means what? Including cash in hand. Unless it should be say specifically that cash is not taking over. If it is so, you don't want to take cash and cash in hand and cash it back. Otherwise, if the question says that acquirer company takes over all the assets, then it means that cash in hand and cash at bank also. Fine. And the second point, no fictitious asset should be taken on. Asset does not mean fictitious asset. What do you mean by fictitious asset? They are not real assets, but we are just considering it as asset. For example, preliminary expenses. What do you mean by preliminary expenses? The expenses incurred to the company before incorporation is known as preliminary expenses. We can write off that expenses. That's why we are putting it as an asset in the balance sheet. They are not real assets. So if there is any fictitious asset in the balance sheet, don't take it as an asset. Okay, so fictitious asset will not include as a part of purchase consideration. And the third point, if any particular asset or liability is not taken over by acquirer company, don't take that asset and liabilities to calculate purchase consideration. So simple. And the fourth point, liability. I told you that for finding out net worth, you have to calculate total of assets less liabilities. Which liabilities? Liability to third parties, that is external liability. In liability side, you can see equity share, even preference share, reserve, that all items will be a part of liability. But remember that all are internal liabilities. So, to find out net worth, you must have to take an only external liability. And in your question, it also says that trade liability taking or taken over by the acquirer company. So, what do you mean by trade liability? Trade liability means sundry creditors plus trade payable, that is bills payable. Fine. And the last, once again, it tells you that liability does not include accumulated profit. What do you mean by accumulated profit? A part of profit, that is reserves. They are known as accumulated profit. So that is in an internal liability, it's not an external liability. So these all points should be kept in your mind while calculating purchase consideration under net worth method.